Allah, the most compassionate, the most merciful, I feel much delighted to welcome you, ladies and gentlemen, to the 15th International Conference on Islamic Capital Markets with the main theme of developing Islamic capital markets to converge the Ummah.
The compassionate, the merciful. Ladies and gentlemen, distinguished guests, knowledgeable scholars, it's with great pleasure and honor that I welcome you all to the 15th Islamic Capital Markets Conference.
Actually, we are done with the first day of the event. I hope you have enjoyed it, and we are waiting for you tomorrow morning right at 9 o'clock here at the same venue. Thank you and goodbye.
Distinguished guests, scholars, teachers, ladies and gentlemen. Assalamu alaikum wa rahmatullah. So, this is what I have planned for today. My keynote address focuses on 4 areas, highlighting difference between the Western and Muslim world in terms of Sharia-compliant investment opportunities. Thank you. Yeah. Describing Sharia screening norms in selected countries. I have got a long list of countries whose Sharia screening norms I have collected, but scarcity of time would not allow me to go and describe each one. So I'll pick and choose in the interest of time. I will also finish my talk in at least 5 minutes before to allow everyone or anyone who has interest to ask questions, so that whatever hard work has gone, it also goes to better benefit everyone present here. Third point in my keynote would be conducting a sort of assessment for the prevailing Sharia screening norms across the globe. And then finally, conclusion and suggestions with regard to the theme of the conference, Converging the Ummah. So here we go. Global equity market provides an exciting and regulation-neutral avenue for Muslims to build wealth. When I say regulation-neutral, it means that it is neither stopping people to invest money according to Sharia or not promoting it. So regulation is mostly neutral. As long as, if you look at banking sector, yes, we have to have a special permission to operate on Islamic banking or without interest. But capital market provides that kind of neutral revenue. If you look at the size of global equity market cap, it is 109 trillion USD plus. And if you look at the Sharia compliant market cap, it is 57%, more than 50% of the global market cap is Sharia compliant. That constitutes about USD 63 trillion. I'm talking about overall globe. Equities are structurally Sharia compliant, as we have learned in the previous sessions as well, because financial system does what? It takes money from where it is to where it is needed. And Islam prohibited riba to make sure that capital and capital provider are not superseded on the entrepreneurship. So entrepreneur and capital are brought together, and that is where Sharia compliance required that everybody has to take risk if they wish to share rewards. Current size of the Islamic fund, if you look at, is unfortunately very small. That is just 100 billion globally. And that turns out to be hardly $55 per Muslim in this world. That is the size of Islamic capital market. 16% of global Muslim population in almost 47 countries, having 300 million Muslims, have zero option of Sharia compliant investing. Zero option. So opportunity for Sharia compliance is massive. Globally, there are more than 20,000 stocks which are Sharia compliant. 57% of global market Sharia compliant is already, as I said, is Sharia compliant. That turns out to be 63 trillion. And more than 50% of globally listed stocks are Sharia compliant. So almost out of 40,000 plus stocks that are listed, 20,000 stocks or plus are Sharia compliant. Now I'll move on to comparing what is happening in the Western world as well as the Muslim economies. So if we compare three open equity market, that comprises of 50% of the global equity market cap, and 52% of stocks in top three equity markets are Sharia compliant. These constitute about 61% of the market cap in those selected countries. And these are three selected countries that I have taken: United States, UK, and Germany. If you look at large cap, medium cap, and small cap, so here is the bifurcation. I would not spend time on describing each one because I have a lot more other things to cover up in the time that I'm given. So if you look at total number of stocks which are listed, and out of that, total Sharia compliant. So in US, total Sharia compliant stock is about 4,000 plus. In UK, it is 624. In Germany, it is 182. Iran, we saw that 728 are the total listed stocks. Going further, this is about the Muslim world. Population-wise, I have taken top 7 countries. Unfortunately, data was not available with regard to Iran, Algeria, Sudan, Iraq, and therefore it is not covered in top 7. I tried my best, but I couldn't get the data that I needed to for this study. So if you look at Indonesia, Pakistan, Nigeria, Bangladesh, Egypt, Turkey, and Morocco, taking all these countries together, there are only 2 companies which are in large cap category, $10 billion plus. Between $2 and $10 billion are mid cap. Less than 2 are small cap. If you look at the total number of stocks in these 7 countries, it is 1676 stocks that are listed. Total. Less than 2,000 stocks. In India alone, in Bombay Stock Exchange, more than 6,000 stocks are listed. And that we are talking about top 7 countries. If we compare the total number of Sharia compliant stocks after running the Sharia screening, whatever parameter is adopted in those countries, the number that we get is 708 Sharia compliant stock in this. So on an average, about 100 Sharia compliant stocks in a country. With regard to Pakistan, I have got 304. The data, I know that there are total 738 listed, including instruments, funds, ETFs, and companies. 530 is the number, 532 to be more precise, the number of stocks that are listed. But the data availability of them with regard to Sharia queries was not available, and therefore only 304 companies could be considered for Sharia screening. And out of that, only 114 companies are Sharia compliant in Pakistan. Indonesia has 146, Turkey has 165, Egypt 100, Bangladesh 149, and Nigeria 12, etc. So total number of Sharia compliant stock is 708. This market cap is about 0.4 trillion as against 63 trillion in the global equity market cap that is Sharia compliant. So top 3 equity markets have 5,000 plus Sharia compliant. Top 7 Muslim countries have got 1,676 Sharia compliant. Top 3 equity markets have more than $50 trillion market cap, which is Sharia compliant. Top 7 Muslim countries have got 0.4 trillion market cap as Sharia compliant. This makes us that top 3 markets provide 3 times more opportunities of Sharia compliant investing than the rest of the world. And the size is more than 85 times bigger than Sharia compliant of Muslim countries. So obviously there is a good case for Muslims to build wealth through cross-border investments. Obviously the idea is not only to take money from Muslim countries and encourage them to invest in the Western market, because that is what has come out till now. But the idea is also that what can be done by Muslim countries and OIC countries to make sure that cross-border investment, a share of cross-border investment comes to these countries as well. So that I will cover in my conclusion part. Moving further, cross-border, when we talk about, is also subject to capital transfer requirements. And 47 out of 57 OIC countries allow cross-border remittances with various threshold. So it's not very easy to make investment when you are a citizen of one country and making investment in other country. That's not. And that is the point I think Muslim capital market people should look at. Out of 57 OIC countries, 48 are having stock exchanges, 48. And in those, if you look at number of companies that are listed, that also is very small. India alone would have about 22 stock exchanges, 2 among the largest 12 in the world. So the information about Muslim countries when we talk about, that is what I'm trying to show here. So due to relatively smaller sizes, domestic capital market, there is a massive opportunity of cross-border investment in Sharia compliant equities. So this was my first part of the talk that I said I'll be comparing Muslim world and the Western world as far as Sharia compliance investment opportunities are concerned. And I'm talking about the same rule applied to. Now I'll spend a couple of minutes on what do we mean by Sharia compliance of equities. When we say Sharia compliance, basically we mean Sharia tolerance, because due to exigencies of modern businesses and particularly the pervasiveness of interest-based transactions, fully Sharia compliant stocks are hardly available to investors. When I say fully, I mean 100%. So that is one. Only about 300 companies in the world can be considered fully Sharia compliant, only 300. They will come from Middle East, they will come from Far East, they will come from Indonesia and Malaysia. These are very small number of companies when you want to talk about global investments and converging ummah. Hardly 300 companies are fully Sharia compliant. So because of this paucity of number and options, Sharia scholars have arrived at a minimum compliance criteria, which, while excluding companies in gross violation, also provides investors a reasonably wide choice of Sharia compliant investments. That is what about Sharia screening of stocks. So Sharia screening is a process through which stocks are filtered for investments by a Sharia compliant investor or his fund manager. Why it is needed? Because if we do not have this, then obviously the option is either to leave the market or go into gross violation. Both are not good for the Sharia conscious investors. Now, if you look at the process across the globe, whatever Sharia screening methods are followed, the first thing is to look at the core of the business or core business of the company. or main business of the company, where the revenue comes, what is the product, what is the company's, particular company's objective, etc. So that is known as business screening. Once a company is found to be eligible on Sharia compliant business, then there are three issues. Of late, the third one has become less important. Three issues that becomes very important. And one is, what is the level of non-compliance debt in that company which is into halal businesses? That is known as Sharia repugnant debt, number one. Number two, even if the company has borrowed on interest because of no other option, because of compulsions, regulatory, whatever, there are other side also. Companies do keep money for acquisitions, do keep money cash, and do keep money for various other reasons. Sometimes they do not have immediate investment opportunities. So they do invest those monies into various liquid mutual fund, various options. And that includes non-Sharia compliant options as well. So this is known as, when we try to identify those, that is known as Sharia repugnant income. What is the level of income that the company which is actually into halal business but earning some portion of it through interest-based and other kinds of transaction. And the final criteria is, what is the level of extent of cash and receivables? Because if a company, some Sharia scholars believe, we all, that if the company is only composed of cash and receivables, then trading of it should be only at par. It cannot be traded at discount, and it cannot be traded at premium. If that is the case, then obviously the purpose of being listed or getting listed becomes meaningless, because you cannot be trading at face value. So that is the reason for third criteria. So when we say business sector screening, these are all haram businesses are excluded. Alcohol, swine, tobacco, gambling, financial services, conventional financial services, etc., etc. And then we have financial screening. When these two screenings are run, a company which passes this criteria is known as Sharia compliant, rather than it should be called Sharia tolerant, but compliant word looks better. And those are the companies that we talked about when I started my talk. Dow Jones is now, so I'll move from west to east in order, skipping some countries in the interest of time. This being the first officially Sharia index in the entire world. And this was launched in 1999. I think almost 4 years later, when Muslim World League and Islamic Fiqh Academy said that people should not invest in a company which has even slightest portion of income coming from haram sources, whether it is in the form of impure debt or impure income. But within 4 years, this change happened. So this is copied verbatim. I would not be going into details of these to have better discussions. So, but this is the first one. If you look at business screening, it's almost common across. If you look at financial screening, total borrowing, Dow Jones says that it should be less than 33% of trailing 24-month average market cap. And non-compliant business income should be less than 5% of the total revenue. That is Dow Jones. S&P, if you look at, criteria is almost same except some deviations here and there. But if you look at financials, S&P says that total debt should be less than 33% of average market value of 36 months. So Dow Jones case, it was 24 month. In S&P's case, it is 36 month. Dow Jones started with current market cap. It went on to 12-month market cap, then 2-year market cap. And similarly, S&P also moved from 2 to 3-year market cap. Non-compliant income is common here as 5% or less than 5% of total revenue. This is S&P. Moving forward to Europe, launched in 2000. Business screening, they remove all the companies are into non-halal food production, insurance, alcohol, pork, etc., etc. So I would not read those things. I'll leave the copy here. Those who are interested can get from the organizers. I will focus on the financial screening side. Here, FTSE says that total debt should be less than 33.33% of total asset, and cash plus interest-bearing securities should be less than 33.33%, and accounts receivable should be less than 50%, and non-compliant income should be less than 5% of total revenue. Now you will notice one difference from market cap, average market cap, 1, 2, 3 year to total asset. This is the deviation here you will notice. Now moving further, MSCI, Morgan Stanley Capital Market Index. Here also you will notice that financial screening, they also follow 33.3% total asset criteria. And very recently they have added or 30% of month-end market capitalization of last 3 years. So this is a new change that has happened in MSCI. They also say 33% in total asset and accounts receivable criteria, the last one, again 33% of the total assets. So you will notice here that impure income criteria is not used here in financial screening, but other screenings are used, and everywhere the denominator is total asset and the tolerance ratio is 33.33. This is MSCI. Borsa Istanbul, I've moved to now, some friends here from Turkey. It's quite lengthy actually. I will read it for you that they have also followed, or they follow 33% criteria. But the very interesting thing is, what they mention is that non-compliance should not exceed 33% of the larger of the company's total asset and market value. It's not or market value, it is and market value. I wrote to them, they have yet to clarify, but this is very surprising to me because in many cases you will see that market value is not always in sync with the total asset. We have conducted some researches where we found that almost 50%, 46% companies to be in sync with, but remaining 50% or more than 50% company would not be in sync with 33%, where total asset and market cap is in sync with each other. So which one you are going to use, that is not very clear. They also follow 5% impure income criteria, that is. And one interesting thing is about purging. If time permits, I'll talk about that. Whatever impure income a Sharia compliant shareholder gets, he or she is supposed to purge that non-compliant portion of the income. Here, what Turkey rule says, that portion that exceeds the inflation rate is taken as basis for purging. Now, if the inflation is 36% or 50%, whatever, that means up to that percent, they will not be required to do any purging. That is the basic understanding of this. I'll move on because I wish to cover a couple of other countries as well. This is Saudi, and they follow business screening is one word, that companies' main business activities must be Sharia compliant. That's it. They have not elaborated on detail. And the financial screening, they say that non-Sharia compliant debt should not exceed 33% of total market value, total asset or market value. Here they are better clear than Istanbul. And non-Sharia investment should not exceed 33%. You will notice this is another change from the rest that we have seen so far. And with regard to 5% non-compliant income or impure income, they also are in sync with 5% general understanding. This is Saudi Arabia. Moving further, I'll move to pick one more country in Middle East, UAE. I think one more is there. DFM, Dubai Financial Market. So as we know that in UAE, you have ADSM, you have DFM, you have Nasdaq as well. So here, if you look at financial screening, less than 30% of total asset is the average interest-based lending. Average interest-based borrowing, they take 3 months average. This should also be less than 30% of total asset. And impure income criteria has gone to 10%. That means even if a company has 10% impure income, from DFM Sharia screening criteria, that will still be considered as Sharia compliant. This is the highest as far as any country is concerned, and as far as impure income criteria is concerned. Moving further, I'll move on to Pakistan. I think, yes, AUFI criteria we have put at the end. So this Sharia screening criteria was initially developed by Mizan Bank, then Karachi Stock Exchange. Now it is known as Pakistan Stock Exchange. Here, the borrowing criteria, the maximum Sharia non-compliant borrowing allowed to a company that is expecting itself to be called as Sharia compliant is 37%. First time this breach of 33% has been crossed, this maximum tolerance. But there is an improvement. Earlier it was 40%. Now if a company has borrowed on interest, even up to 30%, 37% of its total asset, that will still be considered as Sharia compliant. As far as non-compliant investment is concerned, they are in sync with any other country, which is 33% of total asset. Non-compliant income, it is in sync with the global understanding, which is 5% of gross revenue. This is illiquid asset criteria, which is actually cash and receivable. They have chosen to use the different word, but this is similar as what I said at the third criteria, which is, so that means at least companies should have 25% of its total asset in the form of illiquid, not liquid asset. And then this is one, the final one is the additional criteria that is not found anywhere else in the world other than Pakistan, is net liquid asset should be less than the total market cap. So this is about Pakistan. Yes, I come from India, so I have taken from India, and I've been part of this creating Sharia index for India and Bangladesh. So obviously, our logic of creating tolerance has been entirely different from 33% logic. So here in India, borrowing should not be more than 25% of total asset. Interest income plus return at the rate of 7.5% from all non-compliant investment should be less than 33%. So this is the most stringent criteria. That means that at least 97% of the income of the company under consideration should be pure from any kind of violation from Sharia point of view. And cash plus receivable, TASIS and this NSC is the most liberal. In fact, AUFI has removed this criteria of late. Here it has gone to 90%. So in terms of borrowing and in terms of investment and in terms of non-compliant income, this is the most stringent criteria across globe. And still about 880 companies listed at, out of 2,000 plus listed at NSC are Sharia compliant in India. This is Malaysia. Some friends are here from Malaysia. This is the only criteria, Sharia screening criteria, that is prepared by capital market regulator. So this, in this respect, it is different. Unlike other, where you have seen private bodies and stock exchanges, etc. But here it is prepared by Securities Commission Malaysia. So business screening, it has also evolved. So it was launched in 1998 and evolved in 2013. So only in 2013 they have introduced this financial screening criteria. Otherwise, they did not use financial screening criteria earlier. So they have tried to bring that in harmony or convergence, as the topic of the conference today is. And they have started using total debt as should be less than 33% of total asset, and cash amount should also be less than 33% of total asset. But for business screening, they have an innovative way. If a company is purely and if the product or income is purely non-compliant, then 5% tolerance is used. If the company has mixed businesses and mixed activities, then 20% tolerance is used for assessing business screening criteria. So Malaysia is, this is Malaysian regulator. Moving to Indonesia, it's a long list of non-compliant. I will not read them. But what is interesting is that this is one country where the borrowing criteria has gone to 45%. Before this, we saw that Pakistan was having 40%, but reduced to 37%. Indonesian stock market index is having still a criteria of less than 45% borrowing should be, not more than 45% borrowing should be from interest-based sources. They also have the Dubai criteria for impure income, which is 10%, and they also follow at least 10% illiquid asset criteria. So this is Indonesia. Finally, AUFI, as we all know, Accounting and Auditing Organization for Islamic Financial Institutions. It is a not-for-profit organization based out of Bahrain. So this is their criteria, and I'll read that for the benefit of all. On business screening, they say that investment is permitted if the objective for which the corporation was established as Sharia lawful. On financial screening criteria, they first write that fundamental rule is prohibition of acquiring and trading in shares of corporations, undertaking transactions in riba and other prohibited things, even when their primary activity is lawful. That is the disclaimer. And after that, they say that exemptions to the above, if memorandum of association does not mention that one of its objectives is Sharia repugnant, number one. Number two, if total borrowing and debt does not exceed 33% of market capitalization. And number three, if the total income generated from prohibited component does not exceed 5% of the total income of the corporation. So 5% and 33% criteria is followed in AUFI as well. So AUFI covers a lot of countries. I believe many countries have said that AUFI standards are compliant as far as regulation are concerned. So I think Bahrain and many other countries would be following this. This is a very a small comparative analysis to explore convergence. And if you see Dow Jones, S&P, FTSE, MSCI, SC, Malaysia, and AUFI, common exclusions are there, which is alcohol, swine, tobacco, gambling, conventional financial services, adult entertainments, golds and silvers, hedging. Some of them have additional exclusions. Dow Jones, weapons, S&P, cannabis, FTSE, weapons, MSCI, hotels and cannabis, and Malaysia, non-halal food and beverages, and AUFI is silent on this. By and large, threshold of all of these is 5%, except in case of Malaysia, where the business screening is done on the basis of 5 and 20% criteria, depending upon what is the nature of impure income coming to. Now, this is the comparative. If you look at, so the previous one, this was about business screening. Coming to financial screenings, if you look at, so Dow Jones, S&P, FTSE, if you see all of them except Pakistan, the debt level is almost at 30 or 33%, between 30 and 33%, except India where it is 25%. And in Pakistan, it is 37%. If you look at cash criteria, cash and receivables, Dow Jones, S&P have removed that. FTSE is having 33%, MSCI is gone more precise to 33%, so on and so forth. AUFI doesn't have any. Denominator, if you look at threshold through which we calculate the criteria, 24-month, 36-month total assets, and 12 months. So you have, in case of market cap, you have 1 year average, 2 year average, 3 year average. In case of total assets, it's a period under consideration. Now I move on to third part of my presentation. I have 5-6 minutes? 5 minutes? Okay, I'll try to finish. I have been running fast. Thank you. So if you come to the appraisal part, the strength of Sharia screening is, as I said, that riba is prohibited to force people to create partnership so that people who have money cannot earn out of their own money, putting all the risk of entrepreneurial risk on the shoulder of the entrepreneur. So it has a partnership approach. It spans a large field of venture capital and private equity. If we did not have this, large number of wealth managers would not be able to make investment. Large number of insurance companies, takaful companies would not be able to make investments in capital market. It also has a confluence of views of Sharia scholars and finance professionals. This is one area where Sharia scholars and finance professionals I have seen, they struggle a lot to convince each other. I have been part of that team for many, many years, and I know that this is a very positive development. And it has also, emergence of various Sharia screening institutions and their methodology has led to healthy debate about threshold and theoretical basis of Sharia screening. So these are strengths. If you look at weaknesses, lack of proper understanding of true basis of Sharia screening. What are we looking at? What should we be looking at? In comparison to what we should be looking at? Where this 33% criteria comes? Is it really applicable to the situation? Those questions are. And lack of standardization of the methodology causes confusion. Some screening norms, as we have seen, differ widely in certain respects from each other. And there is, and this is the serious point that I have seen in my 15, 20 years of Islamic capital market area of experience, there is a tendency on the part of some institutions to make changes in norms merely to suit commercial interest rather than in response to a desire for greater compliance with Sharia. I'm making this statement with full responsibility because I have seen when the company fails, they change the Sharia criteria from current market cap to average market cap to longer average market cap, etc., etc. So that is something which I feel is a very weak point of the industry and we should look at. Coming to opportunities, stock market occupies a pivotal role in the universe of investments across the globe. This is even more so in the case of Islamic finance because when riba-based system is prohibited, then capital market is the area that we should be all looking at. Through stock markets, Islamic finance can operate in such major areas of financial activities such as mutual fund, pension fund, insurance, wealth management, etc., etc. Capital market provides liquidity, diversification, scalability, and assurance of acceptable level of governance and availability of expertise. This is across the globe, it is common. So these are great opportunities. The growth of Islamic finance industry is not possible without the development of Islamic capital market. This is a very, very important statement that without growth of capital market, Islamic finance can really not flourish. And there's a huge opportunity in terms of the number of stocks that we have spoken about. Coming to threats, slow growth and development of stock market in Muslim countries. As I said, out of 57 OIC, hardly 47 have functioning stock exchanges. I have not spoken about how many number of companies are listed there, what is trading volume, and what is the number of investors. Even if you took at the smallest base in Islamic countries, capital market is very sluggish, very small in size. Considering the Sharia importance of profit-sharing base, it is therefore essential for society to develop institutions to provide exit route and thus liquidity to investors in profit-based operations. Poor representation of local institutions. We have seen somebody said that Tawfiq copies us, and the guy was representing S&P. So when our organizations are not having enough wherewithal resources to produce their own norm, we have no option but to copy Dow Jones, S&P, FTSE, MSCI, etc. So poor representation of local organizations is not good for the great growth of Sharia compliant capital market. And lack of institutions with genuine credibility of Sharia screening norms act as a drag on the development of equity market and Islamic stocks in the Islamic countries. So these are threats. Yeah, I know. Less than a minute. Okay, I'm so sorry. So there is a near convergence of Sharia screening. Let me move on to the last. This is my last slide, I promise. In Muslim countries, overall, investment climate needs to be overhauled. This is my conclusion. Financial literacy is to say the least. Listing culture. How many real good business people are really interested in listing? That is one. So listing culture is not there. Financial literacy is not there. Capital market regulation. I have covered 3 points in this capital market regulation. Data. When I'm looking for data, it's hardly available. And in real time, it is very difficult to get data, especially from Islamic world. Disclosures. It is hardly timely and relevant. If I want to know what is the composition of non-compliant Sharia income other than interest, even in Islamic world, it is very difficult. How much income of non-halal food in Islamic world, in listed Islamic hotel is there, it is very difficult to find. So all kinds of relevant information to understand Sharia compliance is not available in real time. There are companies in India which are into sugar, but they also produce potable alcohol. You have to either leave it or you have to include it. In both cases, it's not. Similarly for entertainment, hotel, food, etc. So disclosure is not very something which we take pride of. Approach. How committed our governments are towards inculcating and developing an entrepreneurial culture. Unless a country promotes entrepreneurial culture, local people will not feel excited. And unless they are excited, they will not make investment in those. So all the countries that we have seen have huge capital market. It is because of the local culture imbibed in them. They wish to invest in local businesses. They wish to put their money on new ideas and new things. So that is something. And therefore, overall investment climate, allowing movement of people, capital, and information needs to be strengthened. I thank you very much for your patience. And if organizers allow, I can pick a couple of questions because I have run faster. So thank you very much for your patient hearing. Thank you. Yes, please. Dr. Majid, that was the question I was anticipating. I asked people here, what is the number of companies listed in Iran, what kind of Sharia screening criteria, if any, is used. Unfortunately, I could not get it. So I will not be able to comment what is the Sharia screening criteria in Iran, what is the status, and can we compare Iranian listed companies vis-a-vis other listed companies Sharia compliant. So unfortunately, the data is not available, and therefore I'm not in position to make any observation on that. Thank you very much for your question. Yes. Yes, I'm open to questions. Yes, please. I have a lot more other countries' data that I did not show you in the interest of time. But yes, many, many other countries. Yes, please.
Just a request for a quick comment with regards to there is a certain discrepancy or disparity in the exchange rates being faced by different Muslim countries as well as regional countries. How do you see that as an impediment in terms of cross-border listing?
See, that's a very technical and very important observation. What we do when we collect data as on date basis. And on that date, whatever is the exchange rate, that is applied. And there are data providers who actually convert that information into the currency that you wish to consider, and they provide data in that currency as well. So all the data that has been provided here is from data rating intelligence. They are into Sharia screening at global level. I requested them to provide data. So all the data is from there, and therefore there is one standard for all the data that was presented here. Thank you.
In Iran, we do not require special criteria because we have 100% Sharia compliant economic system. So this criteria requires when we have a interest-based portfolio. So we can say that 5% tolerance or 10% tolerance, but when we have a 100% compliant system on both ends, when it's a relationship of our investor with the company and company with its customer, so that is the thing. I think you could not get the data. Thank you.
That's very important observation, brother. But what I think, even if you have zero non-compliant data, non-compliant debt or non-compliant income, if the data is available, somebody sitting far as I am can still create some kind of thing for the discussion like this. But if the data is not available, saying that yes, 100% it is Islamic, yes, I understand, and there is no question about that. But still, I think it is important that data is available. That brings confidence. And confidence is also very important when we talk about convergence of capital market across Ummah. So confidence, to improve confidence, you provide data that yes, here it is. And we do not need Sharia screening, Sharia tolerance, etc. because our companies are not going to be listed if they are not 100% Sharia compliant. So I think data is still important, irrespective of the fact whether the company is 100% Sharia compliant or not. Yes, sir, I think I'm done with. Once again, thank you very much for your time.